it was at City where she was, I think. She had said the world was going to collapse. It did. Then she went and put her target on municipal bonds and the whole, the states and all the problems they have. And there's a battle going on between her, and she knows, by the way, that's a pretty technical area. Most investors don't really focus on the municipal bond side of things. But she's having kind of a public battle with a guy named Bill Gross, not my partner, but a different Bill Gross, at PIMCO. If you all know PIMCO, they're the largest bond fund in the world. So PIMCO has the largest holdings of municipal bonds in the world. They make their money by people investing in their bond funds. So you can imagine they're freaked out because tens of billions of dollars are flowing out of PIMCO. So there's a public battle going on.
Meredith is right.
Meredith may be right. I don't know.
Well, I'm just saying, in front of everybody, I'm saying she's going to be proven right.
All right. All right. So Alex says she's going to be proven right. She may be. And of course, there's a phrase on Wall Street, what's called talking your book. You ever heard that? Which means if you have a bet you've made and you want to promote a story that will enhance your bet, then you're talking your book. So there's a little bit of disingenuousness or maybe lack of belief. We got that problem with Bill Gross at PIMCO because obviously he's talking his book. He may be right, but he's really compromised.
But that's why I'm so valuable. I have nothing.
Yeah, so Alex has nothing, so he's very valuable. Thank you for that. So who knows what's going to happen there, but in the last 9 months, everything's changed, at least in the venture capital world. And you know, if we look back 10 years from now, I think it'll all hinge on something that's obvious to us right now, which is simply the weekly adjustments in the perceived value of Facebook. And I think that is just what everyone is pointing to, and including VCs. And we all know it's irrational, but there's something exciting about it. So if Facebook is worth 50 billion, now 70 billion, and you know, on shares post, shares posted, oh, has it dropped? I didn't hear that. Shares post, it's now 63 billion. So a few months ago when Goldman Sachs made their investment, it was at 50 billion. But if you see that and you're an investor, you think, wow, what's my company worth? If they're worth that, and Groupon's worth 10, and Zynga's worth 5, and Twitter's worth 8 to 10. And when you hear those numbers, as a venture capitalist, you start going, wow, because see, the nature of our whole industry is that you really only need one hit in your whole portfolio. We usually have 20 to 25 investments. You need one big hit to return the whole portfolio. Now, what that also underlies is the fact that it's a really bad business model in a lot of ways, because the vast majority of investments we make all fail, which is exactly what you would expect, because we're backing entrepreneurs with very little work experience, with PowerPoints, targeting an imaginary market. You know, usually they fail. So someone said to me this week, hey, what do you think would happen if all the air went out of Facebook? You know, I hadn't thought about that. My prediction is if we all looked at Facebook and said the emperor has no clothes, we would be in a major recession in the venture capital community. I mean, we're really, really bad. That is the tent pole that's holding up, I think, the whole market. And some people may say, no, it's this company, this company. And what I'm touching on is the sentiment. The sentiment is you have a $100 billion company, therefore, mine can be worth $1 billion.
Let me ask a question. So if you take Facebook away, remove it, what value is lost by not having Facebook? Where if you look at other companies that have virtual assets, virtual currencies, there's an actual product there. There's a mechanism that's going on. What is Facebook providing that's needed?
So what I think Facebook is providing that's needed is the old imaginary tale, which caused the first internet bubble, which created $5 trillion of wealth, and then we lost $4 trillion. Which is that no business model, and I'm being harsh a second, but no business model, and people looking at your stuff for free is worth $100 billion. Because if you can believe that getting people to look at stuff for free is worth $100 billion, then it's pretty easy to believe that a virtual goods company is worth $10 billion, right? And that Twitter, because it helps communication, is worth $10 billion. So I think that's what the problem is. Now, I'm not suggesting that Facebook isn't worth anything, but we all remember back in the Yahoo days and a whole bunch of other companies along those lines, The business models were about, we're going to aggregate eyeballs, right? We all remember that.
1 in 4 page views is Facebook.
Yeah, page views, blah, blah, blah. And then that became such a derogatory phrase by like 2001 and 2. If you said eyeballs, people wanted to punch you. It's like, have a real freaking business model.
Yeah, but you have to understand something. People neglect to remember that Facebook has multiple businesses inside it. For example, it's the biggest repository for photos and now video. So it surpassed Twitter, or not Twitter, Flickr. It surpassed photo buckets, surpassed all these, including Picasso. So just that by itself is a business, and then now video is becoming the largest repository for video.
Yeah, and I want to make one point. I think Facebook is worth a lot of money. All I'm saying is, let's look at the photo companies. Fox bought, what did they buy? Photo Bucket, and they threw that away for scrap. All the others aren't worth more than a few hundred million. So photo sharing is not a business. Having said that, Facebook has figured out something to get 500 million users. Figured out a way to create billions of dollars of revenue. I think they're close to 2 billion this year. And in advertising, no, it's a great, valuable business. All I'm saying is it's built at the high level around aggregate eyeballs, do it with very little money, and they actually accomplished a lot before they started raising big dollars. Do it with very little money, and that excites everybody who is out there with a little internet business who doesn't have any money, and it excites venture capitalists who don't know exactly how to build a brand new business model. Wow, all I got to do is put in some eyeballs and I build a big business. So I think my main point is that's why Facebook is the kind of the tent pole. And let's all hope that it doesn't get into stress. And when you think about it, back in the 1990s, the tent pole was Intel and Microsoft. Google wasn't around yet. But what was the risk of Intel and Microsoft collapsing? Microsoft had a worldwide monopoly on all desktops, and Intel had essentially a monopoly on all computers. So the risk of them collapsing was very, very low. The risk of suddenly eyeballs shifting from Friendster to MySpace to Facebook, to Twitter, I think there's a bigger risk of that happening. So it's a little bit more of a rickety place we're on. Yeah.
Do you have to worry about the underlying market versus the advertising market, the whole thing that's going on?
Yeah, you're saying, do we have to worry about the advertising market? That's, by the way, something I always thought was really interesting. Back during the bubble, my partner Bill Gross, back then I think $1 billion was like 99, $1 billion was spent on advertising on the web, and it was a $300 billion advertising market. It turned out though it wasn't growing much, so all internet companies were capturing share. And his point was, well, at some point there may be a natural equilibrium where the internet can't really produce any more effective advertising. So you're not going to grow just by pure growth in the overall ad spend, and you're going to stop growing by capturing share. But today, 1994, there was about 50 million in advertising spent on the web. I think it was about $1 billion in '99, maybe $1.5 billion in 2000. Today, it's about, in just advertising, and I'm not talking about pay-per-click search. I'm talking impression-based ads. It's about 50 billion. So just that, 0 to kind of 50 billion in whatever that is, 16 years, that's pretty impressive.
It should be, really for that to be a sustainable valuation, it should be driving the ad spend. In other words, the dollars would be spent online.
I agree.
If they would be spent online, they would be spent online because there's a Facebook.
Yeah, so I agree. We can talk a lot about the advertising. Let me.
No, we're on.
Yeah, go through a couple other things here.
Just real quick, are you going to talk about Nokia?
Yeah, actually I am. I was going to talk about them right now, Ken.
You know what's amazing? This is what's amazing. So here's the market cap. What's the market cap of Microsoft?
230 billion.
What's the market cap of Nokia?
Much smaller, 35 billion.
What's the revenue of Microsoft?
66 billion.
What's the revenue of Nokia?
70 billion.
70 billion.
Oh, 70 euros, so like 110 billion? Right.
So the revenue is substantially more than Nokia.
2x the revenue, and they're 1/10 the market. But that's called monopoly, right? That's what a monopoly does for you. On Microsoft, so this past week, some of you probably remember, Nokia decided it was going to abandon its kind of Symbian operating system and whatnot. It's going to partner with Microsoft. And Microsoft, this great leader in mobile device software, chuckle. So it's funny because there was a Twitter battle going off between some guys within Google who were saying, what is it, like, you can't breed two skunks and make a mink. And then Nokia's CEO was reading the Twitters and writing back, yes, we can, and he was giving much lamer things.
And where's the Nokia CEO from?
He's from Microsoft.
Yeah.
Yeah. But this is what's really interesting to me about that deal. So Microsoft, if you do the math, is going to get between about $1 billion to $1.5 billion per year. If all of Nokia smartphones use their software, they're like what, a $40 billion a year business. So a lot of the heat coming out of Microsoft is we're going to mobile, and this is their big play, kind of partnering with someone who's losing share rapidly, and it's going to add $1 billion to $1.5 billion in top line. Office generates $20 billion in top line. So, and then you say, well, that's interesting. Apple, its iPhone, generated $10 billion last quarter versus $2 billion or $1 billion for Microsoft over an entire year if it gets 100% penetration on all Nokia phones.
Did you see also Nokia is going to give an exclusive use of Navtech, which they bought for what, $8 billion.
$8 billion.
So all the mapping software that Microsoft's been licensing, they don't have to do that now, which is another huge savings.
True.
And they can tweak that up. So you're starting to see where Helsinki is going to be losing Nokia slowly to Redmond.
Yes, yeah, I think that's totally right. Once you capitulate the operating system, you are an empty husk, right? You are a bunch of little commoditized devices that the Chinese can produce.
So what's Helsinki going to be known for then once Nokia's gone? Angry Birds?
Woo-hoo! I don't have any idea. But by the way, it's funny, right? Because I don't want to be schizophrenic, but I remember in '97, Q1 '97, Apple, Gil Amelio, the CEO of Apple, was booted. They had lost a record 700 million, which seems like such a quaint little number now, right? 700 million, who gives a shit? They lost 700 million, and then a month later, Steve Jobs came in, and you all probably have seen this again and again.
12 billion market cap.
It was a 12 billion time, and all the epithets, shut it down. You can redeem yourself, but they've got a lot of work to do. And I believe the biggest issue Microsoft